Back to the broader markets. The futures right now, as you can see, are indicate a little bit lower. Mimi Duff is investment professional with Gen Trust. Greg Branch, managing partner at Veritas Financial. Mimi, I'll start with you. I think you and Greg have some similar thoughts, and that is that maybe we had a lot of the gains for 2021. Maybe we've already seen them. Maybe we're range bound. Mimi, you point out you like the recovery trade, but there was a strong performance during the first half, and there are risk factors that could be come to the fore in the second half.
Yeah, that's right. We have put up some great numbers in the first half. Earnings have been extremely strong this year. We're looking forward at some of the potential risks. One, we spoke about the variants in COVID, especially with where we have large pockets of unvaccinated people here and abroad, potential for close downs and slowing economy globally on that. Some other risks that we see is the potential for tech reform that we think could play out over months, quarters, years, but it is something that we're keeping our eye on. Structurally, we think that inflation can run a little bit higher than in the past. Some of the factors that had been keeping inflation down, we think, are easing up. For instance, central banks are allowing inflation to run a little hotter, and the demographics that have really been keeping inflation at bay, we think there's a bit of a shift with more people leaving the workforce, that sort of thing. And finally, we have global tensions, so we're just keeping an eye on that.
As a result of all these things, I'm not sure you're as excited about tech, overweight, so you exited those positions. You remain underweight in fixed income. That was your background, most with fixed income, but then you broadened it out to equities as well. But you don't like it at this point, and slightly underweight stocks. So when you keep everything in mind, what does that leave?
Yeah, so just to be clear on the equities, we do see potential for further running. We just don't think it's the time to be gangbusters long, given where valuations are. We're just a slightly underweight on the equity side. We like overweights in real assets and other assets that can perform through inflationary periods. Industrial metals, for instance, infrastructure. We do like regional banks. We think that they will benefit both from the consolidation and also from higher yields if we see higher yields through the rest of the year.
So, Greg, do you agree with a lot of that? I know that you thought that the great earnings season we just had would help, maybe that the headwinds that we're seeing from tapering and other things, it could be overcome. Now you're not so sure that we're going to have that tailwind.
I agree, and I'm going to take it a step further, Joe. We are going to see a core CPI of 5%, either for September or October. We are going to see an overall CPI of 6% or north of that, and that is going to cause a pullback. Not only for the normal reasons that I talk about with you every week about our supply chains being structurally broken, about the vaccination rates of our supplier countries, about shipping and trucking rates remaining elevated, but the auto market giveth and the auto market taketh away. After Harvey, we lost about 500,000 autos, and auto prices for used cars went up about 3% and remained elevated for several months. IDA is going to take away about 300,000 cars. Nicholas may add some, but here's the key, Joe. This is a historically tight auto market already. We already have a really low supply of used cars, and so, we came in at CPI below consensus, largely because we had a 1.5% retraction on used car prices. Used car prices are going to soar with several 100,000 buyers in the market and no inventory to speak of. Add to that the rent owner equivalent, the CPI accommodation component, has risen by 30 basis points each of the few months, and that's set to accelerate as well. And so what I hoped for, was that the Fed would drop a definitive tapering plan in the midst of that robust second quarter. Now we're going to have this to look forward to, as well as potentially a tapering plan, depending on if the Fed wants to be ahead of this or behind this, and that's all the market will have to focus on amidst decreased expectations for the third quarter.
Can you update us on your view on casino stocks, Greg? Because you like them on valuation and reopening,
right.
But you were worried the one risk was maybe COVID, but now we've got a whole new risk introduced given the news coming from China.
Right. Look, the structural story is still the same, and it was one I talked about a year ago, and we saw a run up into April and May, and now we're back at or below the levels that we originally talked about it a year ago, Joe. But, this is a wait until COVID is over kind of story. There's no structural destruction. There's no long-term secular headwind, and I think we see these results playing out in Vegas, where when you saw Wynn's report, June EBITDA was twice that of April's. The quarter's property EBITDA beat consensus by 45%, and group bookings for 2022 and 23 are already ahead of where 2019 was. And so it is a wait-and-see story, but these things are trading at 10 times EV to EBITDA on 22. And so, this is a hold. This is not a long-term hold. This is not a trade, but, these are businesses that can get to $3 a share in earnings and $3 a share in dividend, trading at 10 times on 22.